next week. As you listen to people's commentary on the radio or read anything, everybody continues to talk about the dollar and how that is impacting commodity prices. And basically, the bottom line is that the dollar strengthens. It takes less dollars to buy a bushel of corn. When the dollar weakens, it takes more dollars to buy a bushel of corn. So basically, as the dollar strengthens, it keeps it is a depressant basically to the marketplace in the world market. It keeps our exports harder to sell, and in the case of corn, it's been very difficult to sell corn. So that is kind of what the trade's looking at. Most of this strength that we've had in the dollar has come from that we're better off than a lot of countries in Europe. I mean, Portugal is in big, deep voodoo. Greece is in trouble. Spain is in trouble. They're basically socialistic economies. Unions pretty well run the governments, and their fringe benefits are way too high, and they're running big deficits. Germany is one of the more stronger countries in the Euro complex, and Germany's probably going to end up bailing them out. But the thing that the German people are asking is that, well, you're going to have to work till you're 67 like we are, because Germans, in order to collect any kind of retirement, you have to be at least 67. In Greece, I think it's like 62. So German economy has already did some changes on fringe benefits and raised taxes, and they're basically going to force the rest of the European countries to do the same, or otherwise they're not going to get bailed out. I think that probably sounds a little familiar what's going on here in the United States and our individual states with all of our states running deficits and whatnot. But that's been the driving force. The other thing is a general idea that the economy is picking up, and there are some sectors that is definitely showing some recovery. Now, the big argument is it's just a recovery from a big liquidation that we had last year, and all we're doing now is restocking inventories, and whether or not we're actually moving any product. I think that's a big argument that we'll probably be told. But that is, I actually think the market is somewhat honorable to a correction. You can see we had one leg here up from the November low there, about 425. This advance here has exceeded it a little bit. What I have on here is 428 minus 1.38, which is Fibonacci ratio, which kind of says 8250 is maybe kind of the upside target. You can kind of see the equal leg up off of the January low. The market has run into a lot of resistance. It's almost kind of shaping up to kind of be possible head and shoulders up there, but I would view it mostly as congestion, consolidation. And this may be what happens to the dollar. We've had a nice recovery off of the low. We might be in trying to carve out some broader based sideways trading range because, the way Washington is spending money, eventually that's going to come home to roost, and basically trying to value our dollar against the euro is not, I think that's kind of a faulty comparison anyway, because see, this dollar index is weighted about 60% euro, about 20% yen, and then about 20% other. And a lot of your growing, developing countries are in that other category, such as China, India. So I'm not too sure weighting the dollar against the euro is a correct measurement. So, but for now, the trade kind of watches it. If the dollar's higher, you can just about bet that commodity prices are going to be lower that day. If the dollar's weaker, But I do think you're going to eventually see the commodity markets kind of detach from the dollar, because I'm not too sure Europe is that important to us in the bigger picture when it comes to at least ag commodities anyway. This here just shows you the weekly index. You can see that big decline that we had last year of 15 points. We've kind of come back up 50%. And for anybody that's watched charts, 50% retracements are usually hard spots on the way up, and they're support points on the way down in any kind of move. So, and you can kind of see from a weekly basis the dollar is a little bit overbought, and I guess this is what I would kind of hope to see here in agriculture, is that that dollar could set back or go into a 2 to 3 week correction. That could probably help us out a little bit on some kind of spring rally. And if it does occur, I think from a risk management point of view, those opportunities will need to be used to kind of cover a portion of your risk anyway, as we look ahead here in the market. Longer term, this is what the Glenn Rings of the world, if you listen to Glenn Ring on Commodity Week, I think last weekend, and even yesterday, he was on the panel. He kind of feels that the dollar is beginning a long-term bull market. Now, for those of us that are chartists, you can kind of see a head and shoulder bottom formation developing. The thing that I want to point out, though, right shoulders have a tendency to take a long time to develop. This is a monthly chart. It could take 2 to 3 years for this right shoulder to develop. So Glenn can maybe be right in the long term. Short term, we could piddle around here between 74 and 84 for a year or two. And I think that's what a lot of people are kind of indicating is that while we're printing money and we're spreading money out into the economy, the general default mode of the consumer is to save it. We're not in the 70s environment where you bought today because it was going to be higher next week, and you had the velocity of money. It was turning over. We don't have that psychology. And if you think about it a little bit, the problem what the market has to get inflation going is kind of the demographics of it, is baby boomers. The baby boomers were kind of the engine behind the economy of the 90s and the early 80s. They were the ones with the good jobs. They're the ones that were buying the BMWs and the Porsches and the Mercedes-Benzes, the $1 million houses. And now they saw their 401k devalued in half. They now see their industry contracting. So the baby boomers kind of woke up in a sense that says, hey, I'm not getting any younger, and if I spend all this money, I need to start saving. So I think you're seeing that big demographics that are pulling back. Most of us, I didn't get started raising a family, so I still got 2 kids in college, but for the most, baby boomers are at least finishing up their college education for their kids, or it's behind them. So I still got a few more years of college expense, but I can see my wife and I have all kind of changed our attitude on spending, trying to be a little more conservative. And if you've got that going on in the economy, it's hard to get inflation going. And that's why the sales revenue from the states, I think something like 37 out of 50 states that rely on sales tax to generate, to pay for their government services, sales revenues is down. These people are just not spending the money on disposable income stuff. And that's what's, anybody in disposable income business is hurting. But that, I think, is an advantage to us in agriculture, is that we are a producer of, I call it energy, where food is human energy and fuel is energy for our industrial complex. So I think